Hello everyone, welcome to this presentation. We'll be discussing trading IPOs today. This is an attempt to explain how to trade initial public offerings. There is always a lot of hype and an average user does not know how to enter or exit an IPO. So we will cover common pitfalls, how to avoid them, and have a plan so that we can trade confidently. The topics we'll cover today are basically who is our audience, what is an IPO in brief. We will also find out facts and myths about IPO. We will understand what are the trading techniques used to trade an IPO. We'll see lots of examples and then we'll have closing remarks. This presentation is geared towards an average investor who gets caught up in the IPO hype, who is listening to a lot of media noise in TV news, radios, news articles, and stuff like that, who has no means of understanding company financials, who does not know how IPOs are priced, who do not have a lot of insider information. So it's basically towards an audience or an average investor who only knows about the ticker name or have heard about the company name but don't have any means to analyze or evaluate an IPO. So what is an IPO? An IPO is nothing but the first time any company offers company shares to public on a public stock exchange such as Nasdaq or NYSE. It is also known as the stock market launch for the company. We will not cover the procedures or the process of how a company goes public in this presentation. Or we will also not cover why companies go public, how are they priced, who is involved, all that stuff. The idea of this presentation is to help you understand how to trade an IPO. So we'll look into that in more detail. These are some of the things that everyone should know about IPOs. There are benefits of trading IPOs, but high gains always come with high risks. So the more potential upside you have, there is a high risk of losing on the downside. There is something called technical price resistance, which we will explain during examples. That is usually comes into play in IPO trading. There are lots of risks involved as company financial information is very hard to find in public domain such as internet, as none exists. There are many myths about IPOs too, so you should be aware of those. Buying IPO on the first day does not provide any significant edge to trading an IPO. One key fact of IPO is that many IPOs drop in price before they make big gains. Hence, you should be very careful in trading IPOs. Now that we covered some basics, let's talk about IPO trading strategy. There are two parts to it. One is rules, and the other one is how to create a watch list. What are the rules? The first rule is never buy an IPO on the first day, as it does not provide any significant trading advantage. So simply do not buy an IPO on first day, period. The second rule is tune out all the noise from media. So stop listening to news, reading news articles, TV, podcasts, blogs, etc. And the third one, the most important, always have a stop loss limit price as soon as you buy an IPO. This is to safeguard you from massive losses. Now, how to create a watch list? We will only consider IPOs in the last 12 months. So if an IPO, if a company goes public and it has been 13 months, then we are not going to look towards that stock as an IPO. So only companies that are going public in the last 12 months. Okay, average trading volume of that IPO should not be less than 100Ks for the last 3 days. This will ensure that stock liquidity is there in case if you have to sell. and we will only consider IPOs which are within 10% of all-time high. So when to buy an IPO? Usually most IPOs will pause once they reach near all-time high price. They will consolidate near that price. Wait for that consolidation. Have patience. Do not chase the price if you cannot get in during the breakout. Make sure you have some expectation of target price. To start with, you can set a goal of say 20% and then increase it as it reaches your goal. Do not buy an IPO before a breakout above all-time high price. Usually many IPOs may come near the all-time high price, but they will not break out and then drop back down. Now when to sell an IPO? Well, if it hits your stop loss limit, then you should sell an IPO. So make sure you stick with your stop loss limit price. Sometimes IPOs will break out, but then they will not move higher. Instead, they will become stagnated and they will just remain near the breakout price for a longer period of time. So do watch out. Make sure you have a new stop price. And let's say if an IPO takes off and it started going higher quickly, do not be in a hurry to sell it. As long as the IPO is above 20-day moving average, it would be safe to remain invested. Now that we know rules, how to create watch list, when to buy and when to sell an IPO, let's take a look at bunch of examples. But before we go there, for simplicity, we have done few things. So anytime you see a green dotted line on the examples, that means the buy area or the entry zone. The green dotted line also represents the technical resistance, which we will again explain during we are showing the examples. The sell area is shown by dark red arrows, where we can place the stop limit price. So if an IPO goes below that, which means you have to get out, you have to sell the IPO. The blue dotted circles are times when you can add to an existing position. So let's say you have bought an IPO, let's say 100 shares, and then you see another blue dotted circle at a higher price, which means that is the ideal point to add another set of 100 shares to your existing position. The red dotted circle would be ideal exit zones, and we'll explain them why we think those are good places to add, good places to exit, buy or sell as we move along. Our first example is a company named Channel Advisor. The ticker name is Ecom. So the IPO came in around May of 2013, and as you can see, the first day it was near between $17 and $20, but after that it simply dropped in price. It went up to 15 and then it started coming back up. Now the all-time high price for this IPO is here around $20, and you can see the dotted green line, which is the perfect buy area. So the IPO comes back up. It takes around close to 2.5 months for the IPO to come near all-time high price. So if you would have bought it on the first day, within a month you would have lost some of your investment capital. Of course, it's unrealized gain or loss, but still. So it takes close to 2.5 months to get back to the original price, the IPO price, and see how it stagnates here. You can see it right here, how it stagnates or it kind of consolidates here. Once it breaks out here, this will be our buy area. So you bought it around $20 or maybe $21, and this should be your, right here should be your stop loss limit price. So let's say you bought here and it went down here, then you absolutely get out. Take a small loss and get out. Do not wish or do not get into a hope stage, which later on becomes hopeless stage. So this is your buy area. You bought it here, and then you see what happens. It just jumps in price significantly from 20 to 30. Once it breaks out, it makes a big leap here. Then it comes back a little bit, pulls back a little bit, and then consolidates again near the high price, and then jumps again. Within a month's time, it has gone from $20 to 35. Then it pulls back again. Now this green line here that you're seeing, which is nothing but 20-day moving average, you can see it right here, 20-day moving average. That's the green line. So as long as the IPO remains above that line, you're safe to be invested. So once it pulls back, it consolidates again, and you can see right here what happens. It does not fall back. It actually bounces off this line. So this becomes another buy area. So first time we bought here maybe 100 shares, and you thought, you know what, this is a good point to buy another 50 shares. It goes back up and comes back down here. Again, it does not fall down. It bounces off of this. So if my stop price was here or here, I would still remain invested. So this is another area where you can add to the original position and goes back up. So from you bought the earlier position was here around 20 bucks. You bought another one around say 32 or maybe like 31. You bought another one around 32 and went to around 40 bucks, and then it came back down, pulled back, but this time it broke. That's not a good sign, and that is your sell signal. As soon as it breaks 20-day moving average, you get out, and you see how much gains you made just within a span of 2 months. Almost double. You bought at 20, added 2 more times, and then you sold at close to 35. Not bad, isn't it? Now once it breaks this price, see what happens. It stays in this range. This kind of becomes a range here. Stays in this range for around 3 months. Doesn't make any gains. And then the next time it breaks off here, this is another point where it consolidates. Say it doesn't consolidate here, but it consolidates above the breakout price. So that could be another additional buy area, and then it takes off from there. So the key points to remember: the breakout price, always buy above the all-time high price. That is absolutely key. Make sure you have a stop limit price, so just in case if it doesn't work out, then you get out with a small loss. As long as the price remains above 20-day moving average, it is safe to remain invested. And make sure once it breaks that, you get out. The second example is a well-known ticker, Twitter. So everybody knew about it. There was a lot of hype about this company and this ticker in the news when it came out as an IPO. It came out as an IPO around early November. You can see it. And the price was close to 50, 45 and 50. But what happened? If you bought it here, man, the first 2-3 weeks it was bad. The price went down to 40, 20% loss right in 2 weeks period. But let's say you didn't buy it. You waited for it to break out. See, it breaks out here. Now it doesn't do a lot of consolidation right here. So one might argue, how can I get in? Well, that's part of doing business. If you anticipate a breakout, you buy it here, so above the breakout price, but you also have a stop price over here. So just in case if it drops back, you take a small loss of maybe $2 and get out. But if you bought it here, then it went up close to 60, it pulled back, it went back up close to 75, it pulled back again, and then eventually it broke out the 20-day moving average close to $62. That is your stop price. So if you would have bought at 50 at the breakout price, this line also represents the technical resistance of all-time high price. So if you bought at 50, within a month's time, you probably made around 20%, because it went to 60, you would be getting out. The third example here is a company called FireEye. It's a security company. It provides computer security, firewalls and stuff like that. The ticker symbol is FEYE. It came out in around mid-September. As you can see, it was trading, the all-time high was close to 45, and then it went sideways, and it took probably close to 3 months to get above the all-time high price. See what happens here. It consolidates before the all-time high price. Our rule of thumb is buy only above the all-time high price. It never breaks out, it actually jumps. What do we do? It jumped from like 43 to 50, and then it went up crazy. Well, as long as it did not allow us to buy here, we do not get in, because it's very risky. It can just come back down like this. So you wait. Do not chase the IPO. It jumps, it goes to 60, then it kind of pulls back. Now this would be your ideal time to buy. It's kind of difficult. Not many IPOs will jump like this, but some do. And then the first pullback you get, that is the ideal time to buy. You see here it has a good consolidation, and then you can buy here when it breaks out above this level. And then you see it goes from 60 to 73. But make sure you always have a stop limit price, and then once the IPO breaks out, your stop limit price becomes this green line. So hope that helps. Now that we have seen few examples, it will be very easy to go through rest of them. So this is another company called OncoMed Pharmaceutical. The ticker symbol OMED. The IPO came around 30. It went down significantly, lost more than 50% within span of 3 months, and then it came back up. Now this time the all-time high price is here. Now but see what happens. It actually jumps. It does not come back up steadily. It jumps, and then it does not break above all-time high price in a good manner. It just like goes above and comes back down, and then it kind of pull back, comes back again, and then it consolidates here. So we buy around here. Now one might argue that, hey, you know what, it broke out, so I bought here. Well, then your stop limit price would be here, in which case you would take a small loss and get out. Now if you bought here, once it breaks out the all-time high price, your stop limit loss would be here, and then it stays above that price. Once it breaks out significantly, confirming a breakout, your stop limit price is no longer this, but then it becomes this line here. Simple, isn't it? This IPO, Artisan Partners Asset Management, APAM, it came out in March. The all-time high price was close to $42. After 2 months, it broke out. So this is our buy area. This is our stop area. It stays about 20-day moving average. So this is another area to add to your original position. But it breaks out close to 50 below 20-day moving average. So you get out here. So you got in around mid-May. You got out around mid or late June, and you made 20%. See what happens next. Once it goes below this, it stays in this range for around 4 or 5 months. Then it breaks out again here, and then it goes back down below 20-day moving average here. So this could be another buy area, and then this will be another sell area. This is another example. Again, the IPO comes in around $17, goes down, comes back up, breaks out, but it cannot sustain the rally here. It goes down again below 20-day moving average. So we got in here, we got out here, but our original stop price was here. Once it breaks out, my stop price becomes this. So we kind of got out without a loss, or maybe a very small loss. So sometimes it happens. We just have to follow our own rules, make sure we stick to our stop price. This is a company called Textura Corp, TXTR. As you can see, the IPO came in around 25. It took 2 weeks to get to that level again. It broke out here. It went to close to $31. It pulled back to 20-day moving average. Another place where you can add to your original position. So you bought here, then you added another 100 shares or 50 shares here, and it went back up all the way to 42. It came back down to 40. Now you can argue here that it went down below this, or you can also say this is another area where you can add to your original position. Whichever way you look at it, this is the point where you can either add or you get out. We just stop over here, then it goes back up here, and this will be your ideal point to get out. So you bought here around 25, added another one around 27, maybe added here or got out near 40 or near 42. So within a span of 3 months. Now, so far all examples we saw were doing good after the breakout. Now this is one where it does not do good after the breakout, and hence you have to stick to your stop limit price. Now this is an IPO called Vince Holding Corp, VNCE. The IPO came out around $31. It broke out about that level. So if you bought here, it went up, but then it could not continue. It came back down. Now this was our stop limit here. So it went below that price. Let's say we didn't sell it. We did not stick to our stop limit. What happens? It comes here, it goes back up. We are in a hope stage that, hey, you know what? It's going to go up from here. But soon that hope stage becomes hopeless stage. And see what happens. That's why it is extremely important to stick to your stop limit price. If it goes below that price, you get out. No questions asked. Simple enough but difficult to follow. Now this is an example where the IPO never breaks out above its IPO price. So as you can see, the IPO came out around 19. It barely goes to 20 within few days. It kind of consolidates here, so our breakout price would be this. But then it never goes above it. It kind of keeps dropping. It makes an attempt here, but cannot go anywhere beyond this price. It keeps dropping consistently. That's why it is extremely important to buy an IPO only above all-time high price. So let's say if you bought it here, your stop limit would be here. So it came back down, you took a small loss and got out. But if you wouldn't have sold it here, you would have to take a very big loss later. So stick to the rules and make your life easy. This is the last example we will look at. Again, the IPO comes at around 15. It kinds of breaks out here. So let's say you bought it here, but then it cannot continue the rally. It kind of drops back. So if you bought it here, your stop limit would be here. You took a small loss, you got out. It drops significantly. It comes back up, but it cannot penetrate the all-time high price. It drops back again. Key thing to remember, buy only above all-time high price. Make sure you always have a stop limit price just in case if it does not work out. Again, it's simple but harder to implement. So make sure you follow the rules. Now that we have seen the examples, we know the rules, we know how to implement the rules. These are some of the things that we should be aware of, without which you will fail to make good decisions. So first thing to remember is pay attention to overall market direction. If the market is in pullback mode, then most likely you will get failed breakouts. If a market is in correction or a bear market is going on, then most breakouts will not work. So even if you see a breakout, you should be skeptical about it. Simple thing to remember, all boats rise in a rising tide. If a market is bullish, means most stocks will go up, which means most IPOs that break out have a more probability of working. The second important thing is cutting losses. It is absolutely necessary to stick to your stop limit price. Once the IPO hits that price, make sure you execute and sell that IPO at that price. It is hard at times, but it is a necessary thing that every investor should implement. We hope by now you have got enough information on how to trade IPOs successfully with good trading plan. There are few things you should be aware of. IPOs provide a way to make significant gains quickly in short period of time. However, it comes at a higher risk. Stop limit price is the key to avoid massive losses. Hence, you should always honor your stop limit price. If you miss an entry, then wait for next opportunity. Do not chase the IPO. One might ask how much risk one should take while investing in an IPO. Now that is something that will be covered under position sizing topic. But just to give you some information on that front, one should not invest more than 15 to 20% of their portfolio in a single entity. If you don't want to take more risk, then you might want to limit only 10% of portfolio to be invested in an IPO. It all depends on your risk appetite, and position sizing is a way to determine how much risk you can take. One might also ask, how can we make 100% or more gains? In short, you want to stay in an IPO for a very long time. Instead of 2-3 months or 6 months, you're looking at probably years. In that scenario, you will have to have a different approach. Now, we are not going to discuss that approach here in a lot of details, but just to give you a starting point, once an IPO breaks out, and let's say it comes back to 20-day moving average, you may want to sell only 50% of your position just to secure the profits or gains. Let the remaining 50% in the IPO with a trailing stop price. Trailing stop is nothing but a percent of high price on that day and following days. You can Google it, but that would be a way to remain invested in an IPO for a longer period. Now, you will find a lot of information on my savingsplan.weebly.com website. We have created a list of IPOs in the past 12 months. You will also find a link for IPOs which are within 10% of all-time high. Hopefully that should make your life easier. These are some links provided here. If you want to use them, they are free. So where can I get IPO list? Nasdaq.com provides you with all the IPOs that have come in, and you can look them up by year, by month. Another good site is stockcharts.com, where you can see the charts for any symbol, not just IPOs, any stock symbol. Now, let's say once you have your watch list, once you have shortlisted your candidates, where do you see them at once? You want to see it in one page. Then finviz.com provides you with a way to see all the stock symbols in one page with the charts. It's very easy and very efficient for visual elimination. So hopefully that should help you a lot. Well, folks, we hope this presentation was helpful and has given you the tools and techniques to trade an IPO efficiently with a good trading plan. We hope it will help you a lot in your IPO trading and make you a better investor as well as a better trader. Good luck in your trading. Thanks for watching the presentation.